everybody. Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital. And today's episode is going to be all about the habits of highly successful founders, from a founder entrepreneur himself. And what I think from an investor perspective, what investors should be thinking about when they're evaluating founders is part of why we wanted to do this topic. But obviously Alex is the CEO, founder of Quorum, a super successful entrepreneur, and he's going to be sharing a lot of his perspective on this too. And before we get started, Alex, I'll let you introduce yourself and maybe share a little bit about your journey and Quorum, and we can use that for context for the rest of the episode.
Happy to. Paige, thank you for having me. As Paige mentioned, Alex Wirth, I'm the co-founder and CEO of Quorum. We're a public affairs software company based here in Washington, D.C., so we love being on K Street Capital with the tech community in D.C., although we realize it's obviously much broader than the tech efforts here in D.C. But what we do is that we provide all the software for government affairs teams at nonprofits, Fortune 500 and Fortune 2000 companies, trade associations, advocacy groups, as they engage with lawmakers on Capitol Hill, all 50 state legislatures, and in municipalities. And over the course of the last 10 years have built out the platform of all the different pieces and tools and technology that they need. I started the business about 10 years ago based on some experience that I had up on Capitol Hill doing advocacy work. Very excited to come and share some of the lessons along the way with you all and your listeners.
Moving into the main meat of this episode is just habits of successful entrepreneurs. And I have some of my own perspective. Obviously, I was a founder also before I was an investor. And of course, we've invested in 75 portfolio companies. So we know a lot of founders. So we try to think about what are the data points, the things that really do matter when you're like the people that back the company matter more than probably anything else in most cases when we're at the stage that we're investing in, and just trying to think through what those are. And also like for our audience, which is a lot of founders, how if they're thinking about the things that they might want, the muscles that they might want to develop as they're building their business. So I'll stop there. I would love to get your thoughts on it, Alex, first.
Yeah, so I have a ton of thoughts. One, I think when you start out, there's this old adage that goes, every startup needs two people involved, and ideally two founders, two senior leaders. One who's a hacker and one who's a hustler. And it's very direct in that phrase, and obviously it's probably a more polite way to phrase it. But I think it is helpful. You need someone to sell the product, and you need someone who can build the product. And I was very fortunate to have that in my co-founder, Jonathan, who came from the technology world, was a computer programmer, engineer, and so he was able to come and bring the Quorum product to life. And then I spent time, and we did our senior year of college, flying down to Washington and meeting with customers and saying, what do you need? And they'd come back and say, you can build this, we'll pay you money. And so then I came back to Jonathan and said, okay, can you build it? And the answer was yes. And we just did that for again and again. And I think that having those two components is so important, because if you have one and not the other, you're going to have no customers. Or on the other side, you're going to have a ton of customers, but you're not going to be able to deliver. And so you're not going to have a successful company very frequently. So I always say you've got to start there in having both of those skill sets as you think about coming and getting off the ground.
So how do you think about that for a solo founder?
It's interesting. I think it's hard to be both in that it's two very different skill sets. And I had drinks earlier this year with a founder who was struggling with that, who was much more of a sales mindset, was like, I must learn how to code. And what I was seeing happen is they were going down this rabbit hole, spending all this time trying to learn how to code and do something they weren't good at, that they weren't end up going to be able to create 10x the company or 10x the value. They were going to get stuck. And so that's where I think the answer to your question is like, you've got to build out a team around you that has those skill sets and has that expertise. Now, I will say the only thing that is changing is this whole programmatic and AI-based coding era where it's becoming easier and easier to come and code without the same technical skill set. And so there may be a world here where you could have more of a sales-oriented founder in a place that they can actually create and run product and get something off the ground. But we're, I think, in the early innings of that. And I will say that as a company scales, the technology expertise is going to be critical because it is really complicated to run technology at scale with hundreds or thousands of accounts and users, and the complexity will only grow because your customers will ask for more. So you can't underestimate that future technology need that you will have. But obviously, as you either raise money and have money in the bank or get scale and revenue, you will have resources to be able to hire that out. And so that is something that I think you can solve for.
Yeah, it is definitely changing over time. You can do more with less now, I think, but it's still critical, like extremely critical to find that person, find the right person, and make sure that you have a good team set up to scale. Super cool.
So maybe just taking on that team, the second framework that I find very helpful, there's a Stanford Business School podcast on this, which is where I originally got it from. But it's how the CEO's role changes as it scales, and it speaks to this importance of the team. And essentially, if you think about the company from 0 to 60 people, you as CEO have to be Superman. Everywhere, everything, to everyone. Like, it is on you. And one of the benefits about having two co-founders is you get two Supermen. So like I was the superhero to everything on the sales and marketing and customer side, and my co-founder Jonathan did all of product and engineering and dev, and like you're two people running at it. But you get to a certain size, usually around 60 people, 70, maybe 80, where like that doesn't work. And you start holding back the business because there's so much going on that you can't be everywhere to everything to everyone. And so then you have to change, and instead of being Superman or Superwoman, you have to be Captain America and have a team of superheroes around you who can be everything and everyone to their departments: product, engineering, customer success, sales, marketing, finance. And it's all about the strength and quality of the team that you build. And then I often tell our team now, we're 330 people in total, but that model then has to be totally morphed, where I become like the coordinating council of the Captain Americas, and each of my executives has to be their own Captain America with superheroes underneath them who can be everything and everyone. So our marketing leader, Captain America, has to have a product marketing superhero, a demand gen superhero, a communication superhero, a brand superhero, all underneath them to be most impactful and effective. And I think that's a very important thing of thinking as a company scales. How do you make sure you have that right team? And also, you've got to give up control. And there's the great, I think, first round article on giving away your Legos that we talked about a lot. You have Legos that you love, things that you do, and you have to give them to someone else. And that's the hardest thing. But it becomes so essential as you scale over time.
I love that. I'm going to have to look this article up. I don't know if I've even seen it, but it's an important topic for sure. And that was actually one of the things that I think about is like your ability to manage and build the team is probably like one of the most critical things, and like being habitual about it and constantly making sure that you have the right culture. And I guess like I would say the right communication strategy, right? If you're the one that everything rolls up to in the beginning and you have to figure out how to communicate and what the culture of communications is for the firm as you grow, when you've got those other superheroes communicating for you, it's hard, right? But I think it's so important, and I think that's just very much in line with what you're talking about.
But you hit on a key challenge that happens to all businesses. And I was in a session where someone was talking about communication in a business school class, and they mentioned that if you do a survey of large companies, the number one thing that comes out is people feel like there's not enough communication, no matter how much communication you do. And when you think about it, you communicate out, someone remembers 50%, then they communicate it to someone who remembers 50%. And just in 3 layers, you only have 25% of whatever it was that you communicated out. And so I've often heard of CEOs talk about their jobs of really it's chief reminding officer. You have a series of things, you say those same things over and over again, and that's how it cascades out. Now, it's much easier when you're smaller. If you have a team of 10 people, you can get together, stand up every day, you can be that superhero, organize where people are. But just to show how things scale, at 330, we have 1 company goal each year, and we have 3 company objectives. And every month at Co-founder Q&A, I'm talking through, here are our 3 objectives, and here's what we're doing on them. I do weekly videos and talk about the objectives. We talk about them with our leadership team. Like, everyone at the company knows the 3 objectives. And it almost gets to the point where like it's a little bit embarrassing. Of like, Alex, stop talking about these 3 objectives. That's all he talks about. But I have to say it 10 times or else people will just forget and then be like, oh, this is a priority, that is a priority. And it's about, no, how does it advance? And having that communication and clarity becomes so important as you scale, because that's how you get everyone moving in the same direction.
That's so true. I've never heard anyone say it like that, though, actually. I think that's great advice. Did you have a comms background at all?
I didn't. I started this out of undergrad. I came a little bit from the political world and was White House intern and Senate page. And then I did have the opportunity to do speech and debate in high school. So that learned how to speak more extemporaneously. And I do think it's one of the things that being a founder teaches you is like you're going to be out talking to people and pitching significantly. When you think about raising money, like you're going to have dozens, if not hundreds of conversations about your business. Customer meetings, you're going to show up in all sorts of rooms. And I've been in rooms with 100 people doing demos. I've been in rooms with 2 or 3, but really important people. And so you just get used to that, but it is a key skill set that is one that you will get better at. And I think that's one to just to know is like, it is a practice thing. And so even if you're not good at it now, it shouldn't be a barrier for you becoming a founder, and it's something that as you just do more and more, you'll become more and more comfortable with.
Yeah, I think that's definitely true. It's an evolution of improvement. Which actually, that reminds me, there's another habit that I think is really important, which is just the ability to continually be always learning and improving. And if you're not doing that, then probably the direction that the business is going isn't doing that either, I think. And so I'm just curious how you guys think about that, like the constant learning and constant evolving the entire business, from the product to the strategy to everything.
Yeah. Look, I come in, as I mentioned, from a fairly interesting perspective of that this is the only job that I've ever done. So I've never worked at another company. I've never gone to business school. I don't have the benefits that maybe some other people might bring to it. And I share with that's totally okay. We arguably have been very successful at Quorum without having that external perspective. But you are spot on from the capacity that like you have to go and learn. And so I think in this total, I've probably read something over 50 plus different business books over 10 years. And for that was in many cases a mini MBA of you just learn all these strategies and different ways of thinking about it. And it's very helpful because you can come and bring that and apply that back to the company and change and tweak things of leveraging and using it. To your point, the CEO's job changes over a frequent period of time. I often say that every 6 months now, my job changes because there's something new, something different, something I have to be doing, and that is going to need me in different places. And so I have to think about evolving. And as the company grows and scales, that happens too, because the same way that you go from Superman to Captain America to then the coordinating council of Captain Americas, you have to change your operating principles and where you're spending time and focusing, and you got to get better at managing and hiring and coaching versus the actual doing that is going on. And so all those transformations are really significant. And then the last part about it that also highlights like the whole world is changing right now. And we are going through this massive innovation wave, which we should spend some time on here in a minute. But like also as an entrepreneur, you need to be smart on the world around you and the technological innovations that are happening with generative AI, what other companies are doing, how that fits into your tech stack, to your team's tech stack. So that learning really never ends. And I think it's part of what makes the job so interesting.
I completely agree. I do want to talk about the innovation wave. Just made a note so we don't forget about it. But other habits, I guess the other one I wanted to ask you about, there's two actually that I wanted to ask you about, and then if you have others, I would love to hear what they are. But one of them is understanding cash flow. And I guess in your case, we were talking about this earlier, but you're not venture capital backed, right, necessarily. You guys were bootstrapped for a while, and then you raised capital, more like growth equity later. But it still matters. Like, I think being able to understand your cash flow and when to make hires and when to make investments and when not to, and when to pull back when you see something that's not working faster so that you can save the dollars for what will be working in the future. I think a lot of people don't think about that. A lot of founders don't think about that. And if you're not like on top of that, or you don't have a person, a co-founder that is always looking at that and thinking about that in the strategic direction, it can create terrible problems down the road. Yeah, would love to hear your perspective on that.
Yeah, so like I think it's a great topic and one that we agonized about during our early years of how many months of runway to have, and we had a stable, growing, recurring revenue business, and so it was always this push and pull of do you put more money in and more gas on the fire? Okay, but that increases your costs. How does that change your months of runway left? What's the burn rate? What's the opportunity? And I will say it is worth the time to get a good financial professional to at least come and give some advice. And I remember we called up a CFO of a very large private company that got bought by a public company and asked him a little bit like, okay, how do you approach months of burn, months of runway? How should we think about this? And that was so incredibly helpful. And I think in this broader entrepreneur world, there's this pay it forward mentality that the same way they come and helped advise us, there will be other people who got that same advice and are willing to come and pay it forward to the next generation that's coming up. And so take advantage of that, but also take advantage of your investors. K Street Capital can be a great resource for this. The investors think about this all the time, and it is there of making sure that you have enough runway and you're thinking through that and you know when you need to go and raise more or make cuts. The other side of this is too when you need to put more gas on the fire. And we would often have, as we were growing, we'd have a lot of conversations with investors and they'd say, all right, what if I gave you another $1 million? What would you spend the money on? And that thought exercise was really helpful for us because we went, oh, sales has taken off. Actually, what we need are more BDRs. And then we have the thing and said, oh, we have 12 months of runway. What if we just had 11 months of runway and hired a BDR? And then we hired a BDR and we grew more. And so then we had 11 months of runway, but we were growing even faster. And that is very helpful. And so what you will find in that cash flow back and forth is that there very well may be opportunities where what is constraining you is your cash. And I think that this is one of the more critical places that VCs can play a role, is that if you find your cash is constraining your growth, then you want to go and raise money and grow as fast as you possibly can to take advantage of that. But if there's a world where your growth isn't being constrained by cash, then it's about how you find that equilibrium so that you can keep the growth up, but do it in a sustainable manner that helps you generate even larger opportunities over the long run.
Yeah, I couldn't agree with that more. And we see founders all the time that want to go out and do another big raise. They don't need to, though, because they have enough cash that they can operate on to get to a much further along milestone down the road, like 12 or 18 months later, and raise later if they want to then. But they don't really need the cash to get to that growth point or that inflection point. They just want to raise it, I think, because sometimes bad advice or everybody's chasing a fancy venture capital Series A round or whatever it might be. And it's not always the right choice. And I think that's important, that people should realize that or be aware of the other options that are out there for funding or for self-funding, right, like you guys did for a while, and really think hard about that before taking VC dollars or any investors' dollars, frankly, because that comes with a whole different world of other strings attached to it that will play out along the way. So it's just something to be aware of, for sure. And the other thing I was going to ask you about is mindset and just resilience in general, like managing stress. Right? Like the ups and downs of running a tech startup that's brand new and disruptive, there's so many. And you've been doing it for 10 years, and you still have a smile on your face, so you can tell us the secrets.
Yeah, so two components to this. One is you start a business, you need to be eyes wide open that you're going on a roller coaster ride. And it's one of the most exhilarating roller coaster rides that you can come and ride in your career, where you're going to have some high highs that you're going to feel like you're king, queen of the world, and the world is awesome. And then you're going to have some steep lows where it feels like everything is going wrong. You're never going to be successful. There's never an opportunity. And then you come up and you go back to the high highs. And that will continue every other week, every other month for a long time. I think what I have found that has happened over time is it's gotten much more of an equilibrium where something good will happen and I'll smile and then go back, and something bad will happen and I'll shrug and be like, oh, okay. And so you just get this emotional steady state. But if you were to look at it on one of those pace or heart monitors, like our first 3-4 years was this, up, down, up, down, up, down. And as we've gotten bigger and more, you start to become a little more insulated to it, and it just evens out. And so there's a great book on the power of emotions at work that is worth reading. And like one of the big pieces of that book is you have to learn how to detach yourself from it and to not get as wrapped up, or else you are going to be ragdoll up down on the roller coaster, and it's eventually just going to become exhausting for you. I think the other thing that is really key here is like you've got to take care of your mental health. This is very intense jobs. There's a lot of work that goes in. The roller coaster, while thrilling up, is also challenging coming down. And so thinking really thoughtfully about that and taking care of yourself, I think, is key. And so what does that involve? One, making sure you're getting a good night's rest, whatever it might mean for you. I've always done that for 10 years, and that's been critical. I work out every day in the mornings and find that just helps reset, calms, you take all advantage of the positive endorphins that come from that. Vacation is critical. A lot of early founders I hear and talk about, they're like, can I take vacation? Can I take a week off? Can I do X or Y? And that is really important because that will help you reset and get ready. And then the other piece is you've got to realize that there are sprints and then there are marathons in life. And when you're signing up for a business, you're signing up, if it goes well, you're going to be operating it for 10 years. Who knows? You could be in my world and doing 20 or 30 years. And so it's how you be prepared for that marathon. And when we started, we were running sprints. Like we worked 7 days a week. Our development team worked Saturday. Our business team worked Sunday. And that way, my co-founder and I could work 7 days a week. We did that insane. For about a year. Like exhausting. And now got to the point where like I make an active effort to not work on weekends. So I go really hard during the week. Come Friday at 6 or 7, I'm done till Monday at 9 unless some sort of emergency comes up. And now I have a 10-month-old at home, so I'm spending time with our baby and spending time with my wife and doing other things there. But that is okay, and you can still have that. And it goes part back to that scaling piece where as you get bigger and bigger, and little extra piece that I would do, yes, it's important. And yes, I will always try and go the extra mile, but it's not going to fundamentally change our directory because our trajectory and our results are determined by the 330 people that work at Quorum and that broader piece of it. And you also have to realize that what you do as a founder is the signal that you send to your team. So there's some companies that have a culture of Sunday is actually Monday, and so everyone's emailing on a Sunday and everyone's working. If you're working, it's exhausting to everyone else, and then you're going to have burnout and turnover on your team. But that tone that you set up at the top ends up being very important for making sure that it's not just you, but the whole organization is working at a sustainable pace, and one that you are leaning into the urgency and the energy, but that you are thinking about, okay, how are we going to do this for 3, 4, 5, 6, 10, 15 years? Because that's how you build truly great companies.
Yeah, 100%. And that's also why I think you need to be self-aware about yourself, right? Every founder is different, and you get energy from different things, and different things exhaust you at the same time. And so knowing which things do have what impact on you and how you feel matters, and when you need to take a break and how much of a break you need, because maybe you only need 5 minutes, maybe you just need a 5-minute walk and that's fine, or maybe you need to take the night off or whatever it is. But I think there's no set cookie cutter formula to managing to being resilient and managing the ups and downs of the roller coaster, to your point, of running a startup. Yeah.
Well, and on that, I would encourage founders of go make a journal of the things you get energy from and the things that don't give you energy. And on the things that don't give you energy, go figure out how to delegate them as you can, or put them on a list. The next person you hire, you say, hey, I need you to do this, if it fits into their role, because then you can spend time on the things that do give you energy. And there certainly are still some things that come up on my desk that don't give me energy, but I have to do. But for the most part, I'm able to go and ask our team to go help with those. And then I'm spending the time on things that do give me energy. And so not only do I do a much better job, but then I also have that energy that I can come and bring across the organization. And I'm able to use that and bundle it to give me the energy that will come and do this for another 10 years or 20 years or however long it might make sense for.
Could not agree more. So those were my two big things. I want to first ask you, are there other habits that you're thinking of that are worth mentioning here for founders?
One of the things I think that's worth hitting on for anyone that is not yet started their own company is that there is this moment of jumping off the cliff. And I talk to a lot of people who have business ideas, who want to do it, who say, okay, how did you get started? And I always tell them the hardest part is jumping off the cliff. Once you're off the cliff and flying with your own business, with your own company, you have team members, you've raised a little bit of money, it gets easier because you start to get the momentum behind you. You have then the resources to go and do it full time. But the scariest piece is I'm quitting my job and I'm going to go do this, or I'm stopping this and I'm starting. And I just highlight that to know that you're not alone in that, and that it's going to get easier as you go and dive in and start flying. And then obviously, the more and more you fly, the more and more comfortable you get. It becomes this exhilarating experience. And if you've jumped off the cliff once, it becomes easy to go do it again, where maybe your first venture doesn't work out, and that's okay. There's a lot of stories about very successful entrepreneurs who really hit gold on their second or third thing that they go do, and they become comfortable with that process. And I share that because I think it's an important thing just that folks have in mind.
I think that's true, and I want to just add to it, when you're a founder, you have to make decisions all the time, and sometimes you're I don't know if I'm making the right. You're not going to make the right decision most of the time, actually. But as long as you learn from it and can get the feedback loop and internalize it and have better outcomes next time around, that's the important thing. And I think sometimes founders get really stuck, they can't make a decision. They don't know what decision to make. They feel like they need to do more research, do more testing, whatever, but that's not always. I think there's a fine line between knowing when you need to do that and when you don't need to do that, and being able to make those decisions quickly. And to your point, the more reps you have doing that, the easier it is, right? You're not so afraid because you know that what's the worst case scenario isn't going to be that bad, and you're going to figure it out from there. So it just becomes more comfortable the longer you're a founder, I guess.
Well,
I would say.
Totally. The other piece I think it was worth talking about is focus. So I'm a big believer in the Jim Collins books. And he's got this concept in Good to Great, which is his flagship one. Highly recommend. Probably one of the most helpful business books of the hedgehog and fox companies. And he compared this to publicly traded companies. The hedgehog ones focused on what they did, and they were relentless in that discipline of their end user, their market, their piece. And the fox ones went chasing opportunities, and they jumped around like a fox, to different things. And what he proved empirically was that the hedgehog companies over time delivered more shareholder value than the fox companies. And I share that because there's a lot of opportunities you start for lots of distractions. There are people that say, oh, I'll pay you money if you just do this. Or, hey, think about this user and this profile. Or, oh, build this product. And so you can very quickly get spread thin. And the hard part is that as a founder, you've got to figure out your pathway and you've got to be willing to pivot. And there may be a world where you might be like Slack and you think you're building a video game company and then turns out you're building a messaging company and that was wildly successful. And so you got to be okay with the pivot, but you're not going to be a place where you can go and build both and say, oh, we're going to build video games and we're going to build Slack, because you're going to get distracted and you're not going to have that discipline of focus. And so being really clear of what are you trying to do? Who is the ICP? Who's the customer? How do you be relentlessly focused on them, relentlessly focused on that execution, and lean in long enough to see, okay, are you really hitting the flywheel and hitting success? Or are you finding where you're just running into a wall? And then you have to have that foresight to be like, hey, this isn't our pathway. We need to pivot, and find that pivot, but be relentlessly focused on that. Because if you have 5 irons, 10 irons in the fire, you're not going to be as effective at going and pursuing that versus pursuing one, figuring out if it works, and then pursuing the second.
Exactly. Yeah. That is also, I think, a muscle, right? Like, it's a muscle that you can develop over time, so as long as you're willing to do it. I guess I want to go back to what you were saying about the innovation wave. I guess we have more time. There are probably more habits that matter in this. There's not a finite list, I think, but I think these really are the most important ones, some of the ones we've touched on. But when you were mentioning the sort of like the evolution of tech today and how it's impacting founders, right? Like how people build companies, how people scale companies, and how you think about your entire like tech team if you're a tech company. It's changing a lot right now. And I wonder how that is impacting you guys right now in your company and just what you're seeing across the board.
Yeah. So this is a great place to spend some time, because I think it's critical to an entrepreneur's journey and something that I didn't really fully realize until being in the middle of one and running a business. And the credit for this really goes to Sequoia, who very clearly mapped this out. But when we look back at the last 25 years, there's been a series of innovation waves that have totally changed the way of what people can do with technology. You look at the 2000s and you had the invention of the internet, and that's where we saw Google and Yahoo and Amazon and all these come out that we now use every day, but that came and popped up. You look at 2008, and that's when the mobile app came out. And that's how we got Instagram and Airbnb and Uber and DoorDash and TikTok and Snapchat and all these things that we now use daily. But that was this huge moment forward where you would have this iPhone and suddenly the world, there was a new Pandora's box. And then I feel probably early 2010s is when cloud computing really went mainstream. And that was the innovation wave that Quorum came out of, because we could suddenly take what is over 400 million pieces of congressional data, and instead of spending millions of dollars to buy servers to go operate it all, we could just spin up servers in the cloud and put it all up in the cloud and do wonderful new things for our users and customers. And then what we had since then is really 10 years of stagnosis, where it was the same B2B SaaS. You could build for mobile, you could build on the web, you could build with AWS, but it was the same. And we built and others built, and there were new companies and new things and new use cases, but there wasn't that fundamental change and leap in what you can do. And I think for founders out there, it's really important to realize, like, we are now growing through a new innovation wave with generative AI. And it's the same thing as when cloud computing came out, or the mobile app, or the internet came out, but the new possibilities are transformational. And so as you think about, okay, you're on the fence about starting a company, or you're in the process of it and doubting yourself a little bit, like, now is the time to get going and leaning into that, because that wave is building and arguably will probably be the wave that we might ride for the next 10 years. And so you're in this amazing place getting started now at that wave.
Just curious your perspective on how it's impacting your view of what your development team looks like over time. Does it mean you're hiring different types of engineers, or does it mean you're hiring less engineers, or how does it impact the business?
Yeah, so really the way that we're thinking about it is it unlocks all sorts of new potential and use cases that we previously couldn't even think about doing, or the way we think about doing it would be hiring a ton of human analysts to go do it manually. And so that's the part that we get really excited about, is the impact that it can have for our customers. We haven't made any changes to our engineering team. We've doubled down on it. And really, we think about it as like, one, we can now do more because we're using Augment and GitHub Copilot and AI coding tools to help us accelerate significantly in that effort and access further engineering productivity. But then on the other side is what we really have changed is our roadmap. And so our roadmap is all focused on generative AI and how we bring in generative AI solutions to that.
I love that. We think about it too a lot. Even just in our small investment business, which is not a tech company, but just the ways that we can employ that technology to make our business better, to help founders more, to be more helpful, to make the right connections at the right time and help them, and to get the right returns.
Yeah, and even on that, what I would say is an encouragement to go and use ChatGPT or Gemini or Anthropic on a daily basis. And as you as a founder need advice, need help, need coaching, it's an incredible resource.
What's the most interesting inside baseball thing you've learned about the process of building a scalable tech company?
Of pieces. One is this question of what would you do if you had another $1 million today? And I would encourage founders, you got to ask yourself that question on a monthly basis, because your business is going to change early on. And so having that just mental check where if you have a big use case for it and you can grow faster and you're seeing that ROI from it and cash is your limiting factor, VC can be a huge propellant there. And so be really thoughtful in thinking about that. I think the second thing just know is like VCs all roughly know each other or know how to get a hold of each other. And so the thing to be well aware of is it's a very small world. And as you team up with folks either taking VC money, those people are going to be really important to the future growth of your company because they're going to be reference checks. Your relationships, your engagement, how you treat people in the fundraising process, your performance does very much impact the view of, all right, are you backable, whether it's the next round for your company, the next company you do. And so really important to be thoughtful on that. But also in the same way, it happens on the other side where YC has a whole list of VCs that have not been so great to founders. And founders also talk. And the VC world is very aware that they need to be very pro-founder and very there and collaborative and successful. Otherwise, they won't have the opportunity to invest. And maybe the last inside baseball thing that I will highlight is that there is a world that as you get more size and scale for your business with VC, it'll give you both primary money that you can put on your balance sheet and use to help grow the business, but also there are more and more VCs that are willing to give you secondary, where you can actually sell your own shares and get some liquidity. But that's where there's this inside baseball opportunity that doesn't mean that you have to be 15 years before you see an exit or see a big payout, but that's part of the value that VC brings, not to mention all the strategic advice and connections and capital that can come as well, but worth highlighting.
It's something for founders to consider that I think they don't realize going into it, and it's certainly an opportunity. And also for the investors, right? Like we've actually had most of our liquidity through secondaries over the last 5 years, I think. Yeah, for our investors. What would you say is your biggest failure, and what did you learn from it?
We were looking to bring on a capital partner in 2020. We went out to a small series of folks who had reached out who were interested in coming in and backing the business. And we did go out to one of the top 10, maybe even top 5 VC firms who was very interested in us. And we were like, oh, wow, you backed all these amazing companies, and I'm keeping them nameless for a reason. Well, let's give you a data room and open up access. And at that point, I think we were growing 80% profitable bootstrap business, never taken primary capital, like really strong company.
Awesome.
Every other firm that came back to us was like, yes, we'd love to invest. Here's a term sheet. Here are the pieces. Like, here's how the opportunity to partner with you. And they came and called us and said, hey, this doesn't really meet our profile. We're only in businesses that are growing over 100% at your stage. And like your 80% growth just isn't good enough for us. And we remember taking that and being like, okay, damn it, like, we're not, I guess, in the top 5% in tier because we're only growing 80% instead of growing the 100% that's their minimum quality of investment. And so I share that example of failure of that there are a lot of ways to have a very successful, very healthy, very meaningful business. At that stage, we were probably 110 team members. Now we're 330 team members. We have 3x the number of customers that we served. We're having an incredible time, so much fun with it. But I just share that moment of failure that your business may not be right for everyone, and that there are, as we talked about earlier, are different flavors of VCs, different flavors of growth equity and PEs for different sized businesses. And it's okay to get rejection. It's okay to be told no. And so it's all about finding, well, who is that right partner for you? And as you find those partners, it becomes critical to the overall success of the business. And I think it's probably worth just ending on that point, which is you are going to need capital as you grow and scale as a business. And so it's one where, yes, there are benefits like we did. We bootstrapped for 5 years. We had a lot of success with that. But our story on it is that we also realized we needed to do M&A as we thought about scaling. And that for us to complete the product vision for our users, we needed to go and buy a piece of software in the pack management space that was very difficult to build. And if we walked into any bank as a small bootstrap business that had meaningful recurring revenue and profitability, they'd look at us and they were like, you guys don't know what you're doing. We'll give you maybe $1 million. And you're like, I can't buy anything for $1 million. And when we took on Capital Partner and partnered with Sarant Capital and did lean into the growth equity and private equity, those conversations with the lenders totally changed. Where they said, we're willing to lend off your ARR and then a multiple of ARR. And it got much more material because their view was, all right, Sarant's not going to let you fail. And they've got really smart people that all went to business school behind and doing their M&A models. And so they did the work and like, this is going to work. And we know the numbers all match out. And that ended up being really critical for our success to scale to where we are today, where we've now done 2 different pieces of M&A. And that wouldn't have been possible on our end without capital, the same way that it wouldn't have been possible for our team members to take chips off the table and do secondary and pay down their student loans and come and put down payments on houses and do all sorts of great things to reward them for their efforts in scaling and growing the business. And also on the other side, like you can end at a point where you don't take capital and you get smoked by a competitor that does. And I think it's really interesting when you look at like the Rippling story and what Parker, their CEO, has to say. All this is on Twitter. He highlights, hey, look, if you're having a ton of success, you've got great product market fit, a huge market growing, someone else is going to figure that out and work on it. And they probably have, and you probably know who they are. And so if they go raise a ton of money and you don't have it, you're going to be coming and showing up with a diesel-powered motor, and someone else is going to have an electric motor and they're going to be shooting straight ahead of you. And so all those examples you've got to be thinking about, and it may not be now, and that's okay. It may not be private equity. It may not be VC. It may be something else of flavor in that. But capital is a really key piece of how you build and grow businesses over time.
It really is, and the process of finding the right partner, to your point, is it's a process, and you just have to look at it that way. And you have to meet a lot of people, and you have to learn what their investment style is and if it works for you. And that's okay. And sometimes it might not work for you right now, but it might work for you later. And now you know that person, you have a relationship, and that time is never wasted in these things, in my opinion, anyway. Even though it probably feels that way when you're a founder and you're like, I just want to build my business and I don't want to deal with fundraising, and you have to do that for a year or 50% of the time or whatever it is for founders these days. It's hard, but I would always remember it's never wasted time. So on that note, last question for you is, what's the best advice you've ever received?
So, given some thought to this, I think a lot of it just comes down to decisions. One, the Jeff Bezos shareholder letters are a fair amount of inspiration and fascinating to see the decisions he went into making Amazon. But his big piece is you've got to move with speed and make decisions. And just with the process of making lots of decisions, you will move faster than your competition or others. And his view is you got to get 60% of them right. And if you're getting 60% right, even if you make some wrong decisions, you will still be moving at a faster pace than someone that is agonizing over them. And then also, as he scaled and got bigger and bigger with Amazon, he would focus more, bring me in on the decisions that are a one-way door, the ones that you can't go back on, and spend more time on those decisions. Because if it's an easy thing of, oh, we're going to test this new marketing effort and we can just turn it off, that's a two-way door. You can close it. That's easy. You can always go back. But thinking about it like, all right, you go buy a company, you don't really get to unbuy that company. Right. Spend the time and get that right. And then within it, one of the modifications and ways that I've picked up somewhere is think about what's the worst that can happen. And oftentimes I get asked, hey, will you make a decision on this? Or what do you think about this? And where my mind goes is, what's the worst that can happen? And if it's something that's very minor or easy or just not that big of a deal, it's like, great, go do it. And maybe I might disagree with it and be in the Amazon disagree and commit, or I might be an enthusiastic supporter of it. And even if I am, you think about what's the worst that can happen and spend your time on the things where the worst that can happen is really significant or detrimental to business or much more problematic. But I've found those concepts very helpful to make more decisions, make them faster, speed them up. And that pace and urgency can help you really significantly in being successful over the long run.
I think that's great advice. Thank you for sharing that. And thanks for all the book recs and article recs that I just got out of this. I think this is going to be super helpful too for the whole audience. So that's a wrap.